I want to hear the rest of it, so that's why I said, oh,
Right.
recorded.
So yeah, we cover like the different plan types. Now, as far as like how we transfer that money, it's gonna differ. It's gonna differ based on what type of an account that I have. So we're gonna talk about transfers first. So if I have like a traditional IRA or a Roth IRA or a SEP IRA, if I have any IRA and I want to move that to a self-directed, that's where I would just do a transfer. So again, this is going to be a non-taxable, non-reportable event, no taxes, no penalties. So we're just simply moving one retirement account to another retirement account. So again, if anybody has like a traditional or Roth, just doing a transfer. So we're going to move it over to a self-directed IRA. And then a direct rollover would be if I have a previous employer 401k or I have a current employer 401k plan. So again, if somebody has a 401k, like say, hey, I got $240,000 in my 401k plan. I want to roll that to a self-directed IRA, just say great. If it's a current employer 401k, we would want to check and see if it's eligible for rollover because sometimes it's not eligible until they actually separate from employment. But if it's a previous employer plan, then that can roll, 100% of the time. So once they separate from their job, they can roll that anytime to a self-directed IRA or to any IRA. But if it's the current employer 401k, 403b, 457 plan, we would just want to check and see if it's eligible for rollover at that point. So that's what we would call like a direct rollover. Again, event to IRA, we're going to file what we call the 5498 form. So basically it just says we're doing a qualified rollover, non-taxable event. We're gonna file the 5498, take care of that for the client. So we're just going to do the direct rollover on their behalf, and then put that into a self-directed IRA. So that's basically what a rollover looks like. Now, there are some rules that come into play for self-directed IRAs. So they're called the quote unquote prohibited transactions. So just in a nutshell, they're pretty easy to understand, but the main ones that you'd want to be aware of is that like a self-directed IRA can invest into certain things. So that would include like life insurance. I do get this question pretty much every day or every other day, I would say. So if a client wants to use their IRA to buy like a life insurance policy, can't do that. That would be considered a prohibited transaction. The same would follow for like antiques. So if it's like, they want to buy like an antique car, or, we have people that do that. They want to just buy it for an investment sometimes, stuff like that. Unfortunately, can't do that. So antiques are off limits. Alcohol, artwork, stamps, and certain coins are also off limits. Obviously, people can do precious metals in IRAs. Has to be qualified IRA eligible metals. So there's certain grades of like gold, silver, and palladium that you can buy in an IRA. So that's totally fine. But there's a lot of like specialty coins, stuff like that we can't put into an IRA. So those are just kind of like some of the prohibited transactions that you should be aware of. And then the second type would be when it comes to like disqualified individuals. So if I have a self-directed IRA, and like let's say I own a piece of real estate in my self-directed IRA, I wouldn't be able to rent that out to my mom, my father, my son, daughter, or spouse. So anybody up and down the lineal family bloodline. So that would be considered a prohibited transaction. However, if it was like my sister or my brother, brothers and sisters are totally okay. So they can live in the property, they can benefit from that property, but it just comes down to the direct lineal bloodline. So that would be, again, that'd be mom, dad, son, daughter, spouse. So those are off limits from like living in the IRA, doing any sort of maintenance on the property as well. So the prohibited transactions just at a high level, if it's anybody in the direct lineal bloodline family tree, it's likely prohibited. We'd have to look at it a little bit closer. But again, if it's like brother, sister, cousin, distant family member, any friends or anything like that, that's totally fine. So if you want to rent out that property, or like let's say that my brother was a contractor and maintenance, yeah. So that's all totally fine. It's just mom, dad, son, daughter, spouse. Like that's where we would just want to look at it a little bit closer to see if it is a prohibited transaction or not. So again, that's called the section 4975 for prohibited transactions. That's on the IRS website. So again, if there's any questions on that, just give us a call, shoot us an email. We can just look at it a little bit closer for the specific situation. And then the last thing you should be aware of is called UBIT tax, so unrelated business income tax. So basically, in a nutshell, what this means is that if I buy a piece of real estate with self-directed IRA and I'm going to leverage that real estate, like let's say I have just enough for a down payment, there are specific types of loans that I can get in the IRA. They're called non-recourse loans. But if I get a non-recourse loan, that's where that UBIT tax is going to come into play. So basically, UBIT tax, it's a certain tax that's taxed just for self-directed IRAs and solo 401k plans. And that comes into play when I'm actually using debt leverage to buy a piece of property. So like an example would be, let's say that I have like $20,000 in a 401k and I roll that over to an IRA. I'm going to buy a $100,000 property. Like same thing, I go to an auction, I see a property I want to buy. I can do that. I can get a non-recourse loan for the $80,000, but I'm gonna have to pay a little bit of UBIT tax every year. So basically anything above 12,500 in profit is the maximum UBIT tax tier of 38.5%, which is pretty high. You know, you're paying a lot of taxes on the earnings for the property that's held in the IRA. So again, you have different deductions that you can take to lower that UBIT tax rate. So there are deductions that you can take like interest expenses, repairs, maintenance that will offset that UBIT tax. But it really depends on, you know, situation to situation, if it makes sense to take out a non-recourse loan. So again, it's something that we can look at a high level with a client and just figure out if it makes sense for them to take out a non-recourse loan. But there are specific loans that you can take in a self-directed IRA. So that's where that UBIT tax would ultimately come into play. So that's just like another example of that. And then we were just talking about disqualified individuals. So again, this is the exact family tree that's mapped out here, but disqualified individuals, again, that would be like the IRA owner and their spouse, and then the lineal family bloodline. So again, that'd be like mom, dad, son, daughter, spouse. So that's basically all lined up on the page there. But again, like non-disqualified persons, that would be like brother, sister, aunt, uncle, cousin. That's all totally fine. So it really just depends like situation to situation. But if there's like a certain situation that does come up, just like, you know, shoot us an email. We can look at it. We can figure out if it makes sense or if it doesn't make sense for the client to proceed with that particular transaction. So that is the disqualified individuals. And then transactions with disqualified individuals. So these are just like some examples. So I won't read every single one, but they're listed here. So like the first one would be like your IRA purchase a piece of real estate from your son. Again, that's lineal bloodline. So that's up and down the family tree. So mom, dad, son, daughter, spouse, that would be considered a prohibited transaction. And then the second one would be your IRA owns real estate and leases it to your daughter. Same thing, you know, up and down the family bloodline. So that would be considered a prohibited transaction. So, but again, if it's brother, sister, anybody else, that's like distant family, that's totally fine. But these are just like some examples of what that looks like. So we're going to go through like a case study. So this is just like purchasing real estate directly with a self-directed IRA. So we'll walk through this in a little bit more detail here. So basically the case study here is Joe opens and funds an Advanta IRA account. So basically he completes the application. So it's all electronic, right online. Takes about 5 minutes to fill out the application. So that account opens that same day. So we get the account open. And then we do a transfer and roll over funds from an existing IRA or 401k. So like, let's say he had like a 401k plan, you know, he wanted to roll that over to a self-directed IRA. We can totally do that. We can help him do that. So let's say the account is then funded. So basically Joe finds a property and then he notifies the Advanta IRA that he wants to proceed with buying that property. So the contract is in the name of Joe's IRA. So it'd be example, like when we put a property under contract like that, it's going to read off as Advanta IRA, FBO, Joe Smith IRA, followed by the account number. So that's basically how we would close on that property. It's going to be under the IRA name, not under Joe's name personally. And then just moving forward, so Joe approves the contract, and then he sends that to Advanta IRA for execution. Again, that's where our account managers will come in. So every client has their own account manager. So whenever they want to like close on a piece of real estate, they see something they want to invest into, they can just email or call their account manager, and we'll walk them through that process. So that's just like a good example of what that looks like. So basically, at the end of the day, all documents in the deed are drafted in the name of the self-directed IRA. So Joe reads and approves all the closing documents, and then that transaction is completed. So that's just an example of what that looks like in a little bit more detail. Another example would be renting the property. So getting that cash flow back into the self-directed IRA. So if I buy a property in a self-directed IRA, the IRA owner selects and qualifies that property. So they're going to choose whatever property they want to buy. And then Advanta IRA signs all leases and receives all the rent. So basically, If somebody's renting and they're going to put money back into the self-directed IRA, we have an electronic payment system that they can use to pay their rent directly into the IRA. Or they can send us a check every month. So there's a variety of ways that we can receive that rental income back into the IRA. But we have that all set up like right on our website and directly in the client's portals as well. So they can just, set that up by themselves, or we can help them do that. But basically that rental income, it's going to flow back into the IRA on a monthly basis. And then we can even reinvest that money if we want to for the client. So we can put it into like a money market fund or like a stock or a bond or something like that, just to keep that money working as that rental income is coming back into the IRA. So basically, we're aiming to get that cash flow back into the self-directed IRA over that time. So basically, that's for renting a property in a self-directed IRA and why that ultimately makes sense. Now, as far as like expenses, so this is the other side of the coin. So if I own like a piece of real estate in my self-directed IRA, the IRA is going to be responsible for those expenses as well. So let's say that I need to repair a roof or I need a new front door. I need to make any sort of payment out of the IRA to do any sort of expenses. That would ultimately come out of the self-directed IRA. So this also comes into play like when we're looking at buying a property. If that property like needs a lot of rehab work and there's a lot that needs to be done to that property, then we might want to think about like, well, how much extra money do I have in my IRA to ultimately pay for those expenses? So like if it's going to be a lot more maintenance than I have in the IRA that's left over, then obviously like if I run out of money, then I'm technically out of money in that IRA. I can do my contribution, so I can do my $7,500 per year into the IRA as a contribution. But if I'm still like underwater, then that would be kind of like, that would like fizzle out at that point. It would just like come to a stall on that property, which we don't see it all that often. Like we generally like will walk through that, but we do see it occasionally. So that's why, when you're looking to buy a property in an IRA, we just want to think about like ultimately how much expenses are going to really be involved with that property and that long-term ownership. So you just want to think about like the expenses that are associated with the property. And then as far as like repairs and maintenance, so some things that, you probably, if you're familiar with self-directed IRAs, you've probably heard this from people before, but just to walk through that, like if I own a property in my self-directed IRA, the IRA owner can't perform the maintenance and repairs on that property. So like, let's say I buy like a rehab project, if I go in there, I can't like rip out all the flooring and like install a new kitchen and do all that myself. I would have to hire a contractor or like a third party individual to do that rehab and that work. So this is something that we do walk through with our clients as well, just to make sure that they're clear on it. Now, obviously, people will, behind a closed door, obviously, if they like do basic stuff like clean the property, pressure wash, like basic stuff like that, like that's not going to be considered a prohibited transaction. But if they decide to like do any structural changes to that property, like a new roof, like anything like that, that could be deemed as a prohibited transaction. So just want to, think that through ultimately and, make sure that there's like somebody else that's going to be involved with doing that rehab and that work and not the IRA owner directly. So basically who can do the work? So it'd be a non-disqualified person. So again, like my brother or sister could totally work on that property, like a cousin, a distant family member, friend, contractor. That's all fine. It just can't be like my mom, dad, son, daughter, or spouse, or myself. Basically, that's doing the work on that property. So that's what comes down to like when we're looking at like managing the property. Yeah, go ahead.
The problem if I own like a property management company or, or a roofing company, or I'm a partial owner in one.
Yeah, great question.
Like HOAs run into this, like.
Yeah.
Higher because like who else, like I don't know if that's.
So technically speaking, if I like, let's say I own a roofing company, that's a great example. And one of my employees are going to do the work on that property. Technically speaking, I would need to be less than 50% owner of the company in order for that to be permissible. Okay. If I'm 50% or greater, we would want to keep that like arm's length and just like maybe, find a different company to do that. Right. But again, like, we're just informing everybody.
It came to mind when you were talking about the rental aspect. I mean, if I have a property management company, would that be like, I guess the kind of like double dipping, like conflict of interest,
Yeah. So again, if you're 50% or greater owner of that company, then we would want to look at, maybe using a different like rental management company.
Okay.
But at the end of the day
Or
too,
like
like,
making my sister become the owner now.
yeah, like,
Your sister, yeah.
yeah,
Right, I'm not your mom.
right.
Not my mom or my daughter. Got it.
Brother and sister is totally fine, but again, like for the the rental, that's the rental payments going back into the IRA. Like the online system is like so modernized now, it's just so easy to use that like, it's really not difficult to do that. So like if I own a, rental property, for example, I'm renting that out to, somebody and they're going to pay monthly rent back into the IRA. I just send them a link directly out of my account online. They set it up online for ACH or credit card payment every month. It's boom, done. Basically it's, it's pretty straightforward. So that's all pretty easy and standard now. But yeah, if there's more involved with like, like whatever for the tenant, then, and I need to use a rental management company, then you just want to use like one that's like at an arm's length at that point. So, but that's a good question.
And then you just submit whatever to the, do you pay it? Like, so the management company would be paid by the IRA, right?
Correct. Yep.
Okay.
Yeah. So the IRA is able to pay those expenses. If you want to go, like if you like get an Airbnb, this is super common, and I need to buy furniture for that IRA, and I want to stage it or something like that. Totally can do that. Those are all expenses that can be paid out of the IRA. I just can't like buy furniture or personally benefit for like my own house. It need to be for the investment property. So as long as the investment property is getting that benefit, then pretty much anything I can pay for out of the IRA at that point in time. So absolutely. And then we're going to touch on private lending. So this is where the IRA is the bank. So the IRA is able to privately lend to other individuals. So this is a case study example. So this is Andrea and Steve's joint venture arrangement. And I'll forward this deck to them after the presentation. So if you want a copy of it, we can disperse it around and send it around. So Andrea and Steve's joint venture arrangement. So Andrea had $100,000 in her self-directed IRA, and she's interested in partnering with a rehabber to flip a house. So she meets Steve at a local investor group and learns that he has a project that needs funding. So Andrea does her due diligence on Steve and the property he is looking to flip. So Steve agrees to use the property for collateral. So this is a collateralized lending transaction. So if somebody were to basically default on this loan, then the IRA would then take ownership of that property. So the property would go directly into the IRA. So basically, Andrea does her due diligence and agrees to move forward. So Steve agrees to use the property for collateral, and then some of his own funds as a down payment on the property. So Andrea agrees to lend him $50,000 towards the project so he can do the rehab. So she lends that money out of her IRA directly to Steve. And if he were to default on the loan, again, that property would then be seized by the IRA at that point in time. So it's a collateralized loan. So she charges a flat interest rate for this particular transaction. I believe it was 12% interest that she charged. So again, all that money went back into her IRA. So pretty easy, instead of Steve going to a bank to get a private loan or, getting a hard money loan from somebody else, the IRA ultimately was able to provide that hard money loan. So again, for private lending, just, basically the things that we'd want to think about when we're going to do a private lending transaction, got to look at the amount borrowed, the interest rate, the length or the term of that loan. So you can choose whatever length or duration that the loan is ultimately going to go out for. The amortization table and the prepayment penalties, equity participation. So if we didn't want to like just charge like a flat interest rate, we could structure this as like equity participation, like say in an LLC. So if the IRA were to be included directly into like an LLC operating agreement for somebody, we can definitely do that as well. A little bit more complex than just like doing a straight on like promissory note loan, but we do see where the IRAs are listed in the LLC operating agreements from time to time. So again, you can get, fairly complex with some of these transactions. And then lastly, like the lender fees and the late payment penalties. So if somebody's like late on making payments to that IRA, then the IRA can enforce like late payment penalties. So again, that can be all structured in the promissory note. It needs to be clearly written in that promissory note document so we can reference that if that were to ever occur. So that's basically some of the things that you would think about for private lending. And then again, basically, yeah, I think you guys get the idea here because I won't read off everything, but basically the loan terms are listed there. So the loan amount again was $50,000. The interest rate was 5%. 2-year balloon note. So basically it was going to be for a duration of 2 years. So you can see basically how that's all laid out for the promissory note. So just got to make sure that's all laid out before we move forward. Everybody's on the same page as far as the terms of that note. And then once we're ready to move forward, we would just collect that promissory note. We're going to keep that on file. So we're going to be able to reference that for the duration of that note. And then we'll process that and send the money out the door to the other individual. So basically that's how you'd want to think about like a private lending transaction. So this is like the end result of that. So Andrea's IRA value, the repaid principal, she lent it out 50,000. She got that 50,000 back. The percentage of the profits ended up being $20,000. So her total earnings here ended up being $21,200. And then Steve's earnings, he had the sale of the house. So he ended up selling that house and, he made, he sold that house for $280,000. So the payments back to the IRA were again $21,200 and total earnings overall were $58,800. So basically Steve made a profit and then Andrea made a profit for doing the private lending transaction. So this is just a good example of two people coming together for a transaction like that. And then just like getting started on the self-directed IRA, pretty straightforward. So 3-step process. So you have step 1 is like you would open an account. Step 2 would be we would fund an account. And then step 3 would be find the investment. So when we open the account, that's right online. Takes about 5-10 minutes to go through the application. Pretty basic information. So it's like first name, last name, address, date of birth. We're going to choose if we're going to do like a rollover or we're going to do a direct transfer when we fund that account. And then once the account is open and funded, we're just going to find the investment. So we can do like, real estate, private equity, LLC arrangement. So just a variety of different things that we can do with clients. So we can structure a variety of different investments with the self-directed IRA. And that's pretty much everything in a nutshell. Again, I didn't want to bore you guys to death, but if there's any like Q&A, any questions, I'm more than happy to answer any questions.
So rental properties, can you own it as a single member LLC and have it in the IRA?
Yeah, so that's what we would call a checkbook LLC IRA. So we do set those up as well. So the idea with having a checkbook LLC IRA is it gives you a little bit more freedom and flexibility for actually having hands-on control of that money. So we work with about 3 different attorneys that have been to IRA that set this up for our clients. So I'll give you an example. So like let's say that I have $120,000 in a 401k. I roll that over to a self-directed IRA. I want to use $100,000 of that to go buy a property. So we would set up an LLC. And then the 100% owner member of the LLC would be the IRA. So basically the client just has to choose a bank. They're going to choose an LLC bank account and they can go with any bank for that. So we then take that money and then we deposit that directly into the LLC bank account. We consider that a private placement. So then the client has direct hands-on control of that money. So they have like a checkbook, like a debit card, for example. So the reason that people will do that is that there's a lot of expenses with that property. Like let's say we have like a lot of rehab that we have to do. Like there's just a lot involved. I have to go to Home Depot over and over again and buy materials for the property. I can totally do that with like my debit card, my checkbook under the LLC bank account. So it just gives you a little bit more freedom and flexibility. So absolutely.
Not really a question, but I think we could talk about like the process of like signing. Obviously, everything's be adopted, signed, sends over to y'all for signing, but also from the sales side as well. Like we can use our title companies and things like that from the sales side. You guys sign on your behalf when we sell the property.
Correct. Yep, that's correct. Yeah, that's no problem. Do you guys like see, has the question ever come up on self-directed IRAs? Like, do you see it very often? Probably, I'm guessing probably not. It doesn't really come into conversation.
The question gets brought up about capital gains tax all the time from our investors and people wondering how they can get around that.
Yeah. So it's a great candidate again for people that aren't going to live in the home. If it's an investment property, that's where we really can shine here, and it makes a lot of sense to take a second look at it. Like, hey, Mr. or Mrs. So-and-so, do you have an IRA or 401k plan? Instead of being in the stock market, you can maybe use that money to just buy this real estate instead under the IRA name. So that's generally like, what we say, like to just to like kind of probe a little bit deeper, just to see if it makes sense to use the IRA money. But Yeah, we work with realtors like all across the country. So we do see them from time to time where, folks are rolling in and they're just going to buy the investment property under the IRA versus, doing it under their personal LLC or under their personal name. So, but yeah, it's a great question. And so we're totally accessible at the office. So if you have like any questions that come up, this is a good one too. If you want to take a picture of this, this is like all of our guides. So this is the virtual guides. So there's the real estate one, and the self-directed IRA, the main one, and then the solo 401k for small business owners. So you can just download the virtual guide and just like, have that on hand if you want to. But if there's any questions that come up for us, like that's my QR code as well. My email's listed. You want me to go back? Yeah. So if you have any questions that come up, like a specific situation, we can look at that a little bit deeper, and I can walk that through, like, and see if it makes sense for the self-directed IRA to ultimately participate in the transaction. Cool. And yeah, that's my email there, and we can forward this presentation around as well. So if it happens to come up, we're more than happy to be a resource for you guys, like for anybody that's looking to use a self-directed IRA at the end of the day. There's no other questions. I appreciate your time. Thanks for stopping by. course.
Any paper ones for old people that like paper?
Yeah, this is an extra paper one, yeah.
I don't know, I saw this stuff, I was like, I'm gonna bring this home to my husband, he's got all those 401ks and needs something
Sure.
to do.
So this is
Exactly, like start a restaurant, exactly what we've been talking about, maybe we can find the money.
let's throw my card in there also. Yeah, we have like these little booklets there.
Yeah, that-
easy, yeah.
Stuff I wanna take to my husband is all the things,
Sure.
because he needs something to
Yeah, but
do.
I don't know.
No, I need to find him something to do, AI is gonna take his job, so,
Yeah.
we're gotta use that 401k money for
I
something.
think you have a typo on one of the slides.
Yeah, I saw that too. Yeah, the marketing team, they didn't check that over before I put that in there, yeah. Okay.
Trying to figure out, he wants to open a restaurant, so we'll see. Anne Marie and I have been planning it.
I know, we have to.
I do.
Yeah.
Good. Appreciate you.
That's my sister Courtney.
Hey, nice to meet you.
Thank you. And my mom, Betsy. You
Hi.
guys, my help, yeah.
So this is awesome.
Appreciate it, yeah.
Super. Yeah, it's just like,
Now I know what.
we,
How to make a rocket ship tonight.
He's not that far, right?
they were, I went and got booked in when we were selling my dad's property.
You want extra one, yeah.
Yeah.
So,
Could turn into real estate
we,
or something.
that's the question we always get asked, is capital gains tax, and I just don't think people understand, like,
I don't know
there's ways
anything about
to
real jobs.
use advantages.
I've never.
Yeah, you're showing a lot.
Say you. Employed for.
So this is awesome.
Yeah, I mean, it literally just comes down to like, if they're looking to buy an investment property, just saying, like, hey, do you have like an IRA, 401k? You can maybe, let's just think of self-directed IRA that, and then from there, like, sometimes it fits, sometimes it's not. So like, if they just reach out to me, I can walk them through and just, hey, is this gonna make sense or not make sense? Just kind of like take it from there. So, absolutely.
In the event, so for, let's say somebody rolls it over, like, could they still, like, you need a loan, let's say they roll like $300,000 in the house, $250.
Yeah.
Could you still get a standardized loan, like an outside lender for the rest of the $100,000, or is that only?
Yeah, so you can, so that'd be like a partnership deal. So like, let's say it's a $200,000 property, I have 100,000 in my IRA. I can do like a non-recourse loan route. I can go get a non-recourse loan directly made out to the IRA, but then I'm gonna have to pay UBIT tax, which is kind of a pain.
Yeah.
I can also structure like a partnership deal. So if I have 100,000 in my IRA, like let's say I have 100,000 in cash on hand, I can partner it that way. If I go get a separate private loan for 100K, I can partner with the IRA. I'm not gonna have UBIT taxes on that. So like half that transaction would come back to the IRA tax free, but the other half of the transaction would basically be taxable. So the idea with that would be like, let's say it's rental income every month, which I'd like to be kind of a pain. So like, let's say it's $2,000 a month for that rental income, and 50% owned under the IRA and 50% owned, with my name personally for that personal loan. Then that rental income will have to be split up 2 ways. So $1,000 will be deposited into the IRA, the other $1,000 has to be deposited into like another bank account somewhere else. But that's where like the checkbook LLC comes into play. So we set up a checkbook LLC and the operating agreement, we're gonna list off the IRA. And then we're gonna list off the individual's name, and then that checkbook LLC can just receive the payments. And then, once a year, they're gonna pay a little bit of tax on the amount that was taxable, but the rest is, we can roll that back to the IRA at any time, or it can just continue to circulate in the LLC. So, we can structure it a variety of different ways, basically, yeah.
For sure.
Yeah.
For the amount, like what percent, is it like 50-50 that goes that route? Or you think it's mostly people that have cash for cash deals with the IRA, like that's a significant amount when they're purchasing a property from like what'd you say, like it's like 50-50, or is it more like 50, like 75% cash and then 25% is that alternative option there? What do you think?
I see honestly, I see like a lot of 50-50 transactions too. I don't know if it's like just maybe like a lot of like our local clientele. I mean, the advance, like I've worked at a couple of different custodians. Like I've noticed like the ones that advance are generally a little bit more affluent than, other custodians that I've worked at. But I do see a lot of 50-50. So like if, it might be somebody that has 100K or 200K in their IRA, and then they're looking to buy like a local property at a sheriff's auction, something like that. We'll see it where like the other half is just cash on hand that they have. But we do see a ton of LLCs as well, like the checkbook LLCs. So 1 in 3 clients that Advanza have a checkbook LLC IRA. It's very high. And the reason being is that you have all that extra flexibility and you don't have to like bend over backwards, like send money different places, because it's just all going back into the checkbook LLC. It just makes life a lot easier.
Cool.
Yeah.
Well, thank you for
Yeah,
doing
of course.
this.
Yeah, appreciate
I
it.
hope we get some people as well for you guys too.
Yeah, no, it's see Keller Williams name, fairly often, I would say, like different offices across the country. So
Do you guys do this at other offices as well?
we do, yeah. I just did one in Baltimore. I just got back.
Oh, wow. So
2
you're
days.
kind of all over the place.
Yeah, they ship me everywhere. Yeah, and I'm going to Dallas, Texas in a couple of weeks. So
Are you? Yeah.
Clearwater, Florida. Yeah,
Okay, so
yeah.
local.
yeah,
Good.
yeah, right on the beach. Yeah,
Yeah.
yeah. No, it's like 21 degrees in Miami or whatever like 2 days ago. It's like insane, like how cold it's gotten. Yeah.
What part of Clearwater do you live in?
So there's an apartment that's like right next to Clearwater Beach. So I'm basically right there.
Oh, so you're on there. Yeah,
I'm basically on Clearwater Beach. Yeah.
Sand Key. Sand Key, so right before you go over the bridge from Bel Air going into Clearwater.
Yeah.
Yeah, we had a condo that was like it looked like it was like a pink moon, kind of the way it looked. It was like a
Very
half
pretty.
moon. Yeah, we love that area.
Yeah. That's awesome. Of course. Yeah. No, I appreciate it. If there's any questions that come up, I'm just an email away. So just feel free to email anytime.
Ben, you forgot your
I
phone.
know, I'm coming back.
How are you?
Good.
No. Yeah, this is my mom, Betsy.
Hi, I'm Brittany. Brittany, nice to meet you.
Nice to meet you.
She's also Instagram, TikTok, frequently Katie.
Uh,
Yep.
Trying to do
Anything good come up yet or no? A little bit. Have you told your fans yet or no?
You wanna call it like